Just over a month remains for Congress to reach a deal on the fiscal cliff. If the U.S. falls off it, the consequences could be devastating for the markets and the economy. With his take, Tad Revell, Fixed Income Chief Investment Officer at TCW. Well, Tad, what are the odds that we'll have a deal on the fiscal cliff by year end?
Well, I suppose we'll have some sort of a deal on the fiscal cliff. I don't think that there's enough time or enough political will to have a fundamental solution. We spend as a nation at the federal level $3.5, $3.6 trillion in total. We take in terms of taxes, $2.4 trillion. So everyone can see the magnitude of the problem. Do we increase taxes 50% across the board to match our revenues with our entitlements? Do we cut our spending by a third in order to right-size entitlements back to our level of tax revenue? I think what that suggests is that this problem is so large that even to the extent to which there is a declaration that we have quote-unquote solved it come January 1, that it's improbable that we have a proper right-sizing of our federal fiscal balances.
Where will a compromise, do you think, be made for a deal?
Well, I think that you're seeing the outlines of it already, is that in all probability there will perhaps be some give with respect to the tax collections that are or relate to higher income citizens. It may not necessarily take the form of higher tax rates, although it might, but it might take the form of lower or limited deductions that would result in the same take you to the same place. And on the other side, there'll have to be some type of proposals or initiatives that perhaps take at least baby steps in the direction of starting to contain at least some of the growth with respect to federal spending.
Now, Tad, you manage $77 billion in funds. How are you positioning your investments ahead of the cliff?
Well, the cliff per se, I don't think changes very much of what we do, but what we would suggest or counsel people to do is to be very defensive with respect to much of your investing in this period of time. And the primary reason being, simply put, the Federal Reserve has been a big buyer of Treasury securities, and consequently Treasury prices have been pushed high, which is to say that their yields have been pushed low. So being defensive in bonds essentially means that you tend towards a portfolio of shorter maturity type instruments, oftentimes higher quality, but certainly extending yourself out and getting a lot of exposure to the bond market at today's abysmally low yield levels is probably not a well-counseled strategy.
At this point, are you selling off to lock in the lower rates?
Well, what we have done is, over the course of the last 1 or 2 years, is reposition the portfolio to take advantage of those sectors of the market that we believe are favored by policymakers, typically and primarily by the Fed. So what are we talking about? To a certain degree, high-yield bonds, emerging market debt, securities that come from the mortgage world that are so-called non-agency mortgages. These are mortgages that do not have the Fannie Mae or the Freddie Mac backing of government. The returns that have been generated from these strategies has been very strong, very powerful, not just over the last 12 months, but really over the course of the last 3 years. But as we look ahead and we see that the yield in these different sectors has been diminished, we are incrementally somewhat more cautious about them.
Now, Ted, let's turn to the Fed. How long do you see QE3 lasting?
Well, the Fed says that QE3 is going to last, I'm going to take some liberties with what they said, forever.
Right.
Right. They've signaled that they have no intention of modifying or abandoning their program of securities buying until they see effectively absolute confirmation of a U.S. economic recovery. From our point of view, this is a signal that the Fed is supportive of risk-based strategies in the capital markets, but I think that it should also be somewhat alarming to investors, because even though you do not see any uptick in inflation, and even though many on our side of the fence in the investment management business have been warning about the possibilities of higher inflation, I think it more or less goes without saying from our point of view that what the Fed is doing is piling more kindling onto the fire, and it may take consequently a smaller spark to ultimately ignite inflationary flames at some point down the line.
You talk about kindling. Are you worried that the Fed policy is creating an asset bubble in junk bonds and treasuries?
I think that to a very great degree, I would put it this way, is that though the Fed would never acknowledge it, their policies are almost inherently designed to create asset price bubbles. That in effect what the Fed is doing is offering drink to the person suffering from the hangover. So consequently, the Fed has been providing a high degree of aid and comfort to the housing market. Now that can be a good thing if you're investing in homes or securities that derive their cash flows off of underlying mortgage payments. But what it also suggests is that the possibility, if not the likelihood, that the Fed is once again recreating some of the dynamics that led us into the prior downturn, which is to say unsustainable asset valuations in treasuries, in mortgages, maybe in other areas as well.
Drink to a guy with a hangover, is this all going to end badly?
In our opinion, probably. We're not at the point. I don't want to sound unduly alarmist. I don't want to suggest that investors should rush out and sell everything that they own tomorrow. It's nothing like that. In fact, the point of comeuppance might still be a couple of years further down the road. But I think that it's fair to say this, is that the totality of policy mix is not sustainable. I think that the Fed chairman himself has made these statements to Congress. I think that the electorate understands that the dynamic that we talked about. You can't go on borrowing $1.2 trillion on a tax base of $2.4 trillion and think that will allow your country to be forever bankable. We have been supremely bankable in the past as a nation. We're still bankable as a country, but if we continue down this road, the nation at some point will not be bankable, and the symptom of that, or the ultimate result, we think will be expressed through a weaker dollar and higher inflation.
Thanks a lot, Tad, for sharing your views with us.
Our
thanks to Tad Revell, Fixed Income Chief Investment Officer at TCW. I'm Fred Katayama, and this is Reuters.